Results out from Africa's biggest maker of semi-fabricated aluminium, Hulamin, show a 28% rise in revenue for the 6 months to June, an increase of 10% in headline earnings per share. Joining me with more is Richard Jacob, who replaced Alan Fourie as CEO of the group at the beginning of the month. Richard, congratulations on the appointment. Thanks for coming in today. A change in direction or a continuation of the policies that have been implemented so far at Hulamin?
Yeah, largely a continuation of policies. Really, we're on a trajectory of growth. We completed an expansion project late last year, and so we're starting to deliver volume growth coming out of that project.
Well, I mean, despite an improvement in the market for you, there have been a number of headwinds over the past 6 months, not least of all the strong rand. Tell us how the strong rand impacts your business.
Yeah, we're an exporter. We export about 75% of what we produce. The rand is currently at the same level it was in 2003. So our revenue really is capped by the rand dollar, but inflation has affected us quite strongly in the South African market.
How do you work with the rand going forward? Because of course we know that the rand never does what you expect it to do, does what you least expect it most of the time. Do you have to work that into your model, and to what extent can you hedge against the rand?
We don't hedge against the rand. At the end of the day, it's really all up to us and our operational performance. We focused on delivering out of the assets that we have. Our business model is sufficiently robust to withstand a strong rand, albeit not at the same profit level.
Of course, you talked about the expansion right at the beginning. As that expansion comes on stream, because that's obviously affected your costs in the 6-month period as well, as that expansion comes on stream, volumes pick up. To what extent will that mitigate the rand at these levels?
Yeah, look, we have a significant growth ahead of us. We really haven't delivered much yet from the project that's only starting now, and over the next 2 or 3 years our volumes will grow considerably faster than our cost line. So that will deliver significantly improved profits going forward. Obviously the magnitude of that profit is determined by the rand dollar.
And of course, just with that strong rand, you're also faced with cheap imports, and you have actually applied to ITAC to perhaps introduce more levies on cheap imports. Have you had any response from them? What's the chances of actually getting that through?
Yeah, we've lost, the South African market has lost about 15 to 20% to imports of cheap Chinese extrusions. We've submitted applications both for rolled and extruded products over the last 6 months, and we're hoping to make some progress with ITAC before the end of the year.
Your exports, you said 75% of your product is exported. What markets are we looking at? Because of course we know Europe under pressure at the moment. Some areas showing stronger growth than other areas. Are you exporting to Europe mainly?
No, most of our exports are to the US, but we have a very diverse geographical profile from South America, North America, Europe, the Middle East, and quite a large position in Asia as well.
Other cost pressures, of course we had those electricity prices coming in a couple of months back. How's that impacting on your cost line?
Yeah, no, we have measured inflation at our gate and it's running close to 11%. So cost pressures in the local market are quite strong. And obviously with the high inflation in the local market and the capped revenue, that's why our profits have been squeezed.
You also mentioned in the commentary that South African and European markets continue to disappoint despite the recovery we are seeing in the global economy. I mean, considering the state of play in Europe at the moment with those austerity measures, would you expect them to continue to lag?
Yes, I think so. We're not expecting any significant growth out of Europe. Bear in mind though that we still remain a very small player in that market, so there is scope for us to grow our market share at the expense of some of our competitors in Europe.
Tell us about the Transnet strike. You say in the commentary it delayed the invoicing of 6,000 tonnes of product. That's going to be recognised in the second half. So when you look at the year as a whole, should, all things being equal, should you see a significant improvement from last year's levels?
Yes. One of the most exciting things about our current performance is that we're seeing this volume growth continuing from the second half of last year. We're on a very positive curve at the moment. Clearly the Transnet strike had a major impact on our ability to invoice, and consequently we've got a significant growth in inventory. But we've continued to operate at a positive level, at an increasingly volume level, and we'll see that flow into the second half and into next year as well. And
will you be able to reduce those inventories to normalised levels by the end of the year, do you think?
We do believe so, yes. Although the strike itself lasted 3 weeks, the port congestion had at least another 3 or 4 week impact before normalisation, which was only seen in the last couple of weeks.
Operational improvements in the business, you saw some coming through in the first half. Are there more to come? You talk about cash cycles, efficiencies, cost cutting. Is there more leanness there to trim out?
Yeah, I think manufacturing businesses in South Africa have no alternative. We have to focus on getting leaner and meaner and more aggressive on costs, particularly going forward.
And of course, you had that rights issue, which has obviously resulted in that 11% rise in earnings per share, as opposed to the larger rise we saw in revenue. Has helped you pay down your debts, though. Are you happy with debt at current levels?
We are happy, yes. We're very thankful to our shareholders for having supported us through that issue of 100 million new shares.
And prospects for the second half, you've mentioned it a little bit. What would you expect for the full year?
Look, we're looking at increased performance out of the business going forward. We're expecting to see increased profits in the second half of the year, but as you know, the current strength of the rand is quite a concern because we're an exporter.
Where would you like to see the rand from these levels? What would be a comfortable level for you?
I think for us, we ask no more than just purchase power parity for the rand to follow inflation rate differentials between us and US or Europe would be more than sufficient for us.
Okay, in that case, what do you think a fair level would be? What would a purchase price parity level be for you?
Probably 8 to 8.50 at the current level, if not closer to 9.
And of course, we have some analysts saying that's all very possible by the end of the year, so you never know.
Let's hope so.